So it's not exactly been the best start to the year for investors.
Stocks tanking today with the tech trade really taking on the chin. Take a look at the NASDAQ 100. Only a handful of names posting gains in today's broad-based sell-off. Check out what happened in the Treasury market. Bonds getting battered, yield rocketing higher. The 10-year soaring above 1.7.
The red flags have been there since January. The stock market's been volatile, inflation's been rising, yield curves are spooking investors, there's threats of a recession, and it all kind of now begs a question as to whether now is the right time to rethink our investment strategy. Which seems pretty crazy to think about because 2021 was such a great year for all of us. It was like the party that never stopped, gains to be made everywhere, but 2022 seems to just left us all with a whopping great big hangover. Because now the script has flipped. From stock market record highs to a potential doomsday scenario of a recession. But will the stock market crash just like Deutsche Bank have predicted that it will? Or is all of this just hot air that we should simply ignore and carry on about our daily business? Well, I'd rather not leave all of this down to chance and leave myself potentially exposed, nor do I want to see too many drastic unrealized losses within my investment portfolio if things do start to get a little bit tough. So today we're going to take a look at the facts, we're going to take a look at the data, and then towards the end of the video we're also going to take a look at what Vanguard says that we should actually do with our investment portfolio. So we all know the situation by now, but if you don't, well, here's a quick highlight reel.
Prices surging more than they have in 30 years.
They anticipate starting balance sheet reduction.
The global surging energy prices.
In the fight against inflation, which is roaring right now, in the past hour, the Federal Reserve announced they'll hike the interest rates. This is the first hike since 2018.
Recession fears are rising with the collapse of the spread between the 2-year and the 10-year bond yields.
It's pretty much where all the worries of investors are coming from, and the uncertainty of the macroeconomic environment is certainly hurting the stock market, with the S&P 500 being down 6.2% year to date and certainly looks like it's struggling to gain any kind of momentum. As a result, investors are beginning to lose confidence in equity markets and as a result are starting to go down the path of potentially rethinking their investment strategy. Because for the most part of this year, when we look at the fear and greed index, we've been sat in the extreme fear territory, which inevitably is just driving more volatility in the stock market so far this year. So what do we do? Well, the latest topic of conversation is recession signaling. And the one signal that's making investors slightly concerned is something called the yield curve.
Traders often look at the bond market for clues on how the US economy will perform, specifically the yield curve.
Given the yield curve inversion,
we inverted back in March. Yes, we now have an inversion.
Even if the yield curve inversion happens again and happens persistently.
The president tweeting out crazy inverted yield curve.
So what exactly is the yield curve and why is everybody talking about it? Well, the yield curve is just a graph which shows the relationship between short-term and long-term interest rates on treasury notes. Now, treasury notes are also another word for bonds, whereby me and you essentially loan our money to the government in return for a rate of interest. And normally the longer which you lend the government money for, the higher the interest rate you'll receive. And that's perfectly fine and exactly what you'd expect in a healthy economy and when everything's kind of operating quite seamlessly. However, when long-term rates actually drop below the short-term rates, that's when we actually have a problem, because it's a signal that starts to highlight impaired economic performance. Now, the best way to think about this is think about being on a motorway, and in the fast lane doing 70 mile an hour is the 2-year bond rate. And in the slow lane, you've got your lorries doing 60 mile an hour, which is the 10-year bond rate. Now, when the fast lane is moving quicker than the slow lane, then the traffic kind of progresses smoothly. But when the fast lane starts to go over the speed limit, that's when the Fed or policymakers will start to jump in order to rein the fast lane back in. And in order to slow everything down, then the Federal Reserve or policymakers will start to increase interest rates. And as a result, the 2-year bond rate in the fast lane starts to slow down to the same speed as the 10-year bond rate in the slow lane, and all of a sudden you've got yourself a flattened yield curve. And with the Fed ever moving faster on hiking interest rates, which is closely linked to the federal fund rate, then we start to get this slowing effect taking place. And as a result, the charts are speaking for themselves, because the inverted yield curve has actually been a great predictor of historical recessions over the past 50 years. The red line shows the inversion of the yield curve, and whenever we've dipped into that territory, a recession has occurred thereafter. From the 2008 recession,
Apple shares are just getting hammered this morning.
we're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are
watching this market deteriorate.
The 2000.com bubble bursting.
The worst day ever on Wall Street. All the major indices are now down for the year.
And even the early 90s recession.
I think there are now tremendous problems being caused not just obviously by the recession, which is still deep and still very much with us.
So where exactly are we now? Where we're very much sat teetering on the edge of an inverted yield curve once again. And as a result, it's kind of spooked the equity markets to think that a recession could be just around the corner.
I want to get to treasuries because the market's getting a sign that a recession could be on the horizon. It's what everybody's talking about. The yield curve inverting after the closing bell. Right now, you're looking at the 10-year at 2.4, the 5-year at 2.5, and the 30-year at 2.5.
So could a recession be on the cards? Well, it's certainly possible, but it might not be as imminent as you think.
The trouble is, recessions follow inversions anywhere from 6 months to 2 years later, so start your clocks now.
So before you take any decisions on your investment portfolio, don't take it from me, take it from Vanguard, who I've actually got an article on, who actually wrote on this same topic. Investors are wondering whether a US recession is on the horizon and whether they should readjust their investment portfolios in response. But Vanguard says investors should not overreact, despite the potential repercussions for the global economy. So what exactly can you do to limit your downside and limit your exposure in what could potentially be some possibly tougher times ahead? Well, let's take a quick look at how Vanguard thinks we should prepare. Number 1, control exactly what you can. Whilst you certainly can't control the stock market, you can control your actions. And when times get tough, you don't want your decisions to become costly ones. The doomsday scenario will forever be presented in the media. And when that thought of losing money starts to take over, then that can potentially then lead you on to decisions that you may go on to regret. So if you're ever in doubt, I always say just zoom out. As this chart shows, since the 1980s, we've actually seen 5 bear markets where the market has declined 20% or more. However, what's more important to look at is the bigger picture, which to me just simply looks like a steadily upward trending chart with some troughs along the way. So when things get rough out there, always remind yourself of the longer term upside trajectory of the stock market, and hopefully that will prevent you from taking any actions or decisions that you may go on to later regret. Number 2 is to simply stay the course. You shouldn't ever pull out of the stock market unless you absolutely have to, because the reality is timing the market is next to impossible, and despite what some people out there may tell you, it's virtually impossible to do with 100% accuracy on a consistent basis over the course of a 5, 10 or 20 year period. And as a result, for the most part, you're simply just better off staying invested in the market. As this chart shows, those who remain fully invested simply end up with more money over the long run than people who don't. The reason being, unless you're absolutely on point with your market timing, you run the risk of missing out on some of the best days within the stock market whilst the stock market is actually falling down in value, because those best days can typically come within the midst of a stock market crash. And if you just miss out on a handful of those best days within the stock market, then your investment returns will be absolutely shot to pieces. From 1999 to 2018, the maximum rate of return that you could have received from the S&P 500 would have been 5.62% per year on average. However, if you missed the best 60 days during that period of time, well, your returns would have been negative 7.41% per year. So stay the course and don't pull out. Third and finally is to review your asset allocation. Look, if you're really worried about the valuation of your investment portfolio fluctuating so much and fluctuating to the downside that you're probably going to lose sleep over it, then it's probably time to revisit your investment portfolio and the exposure in which you have. Now, of course, we're all invested in the stock market to make money, but you must ensure that you're acting in a way that operates in line with your overall risk tolerance. Because if you're out of balance, you may again go on to make decisions that you may go on to regret. So take a look at charts like these where you can weigh up the performance of different asset classes over recent years, potentially weigh up where you can balance slightly lower risks that still potentially could provide you with a good reward, and diversify your investment portfolio appropriately in a way which feels comfortable for you. But if you're not too sure about where to start with diversification, asset allocation, maximizing your investment returns, along with operating in line with your risk appetite too, then be sure to click on this video here. It's a video which I made where I talk about the top funds over on the Vanguard website. And with that being said, I'll see you over in the next one.